Hello, welcome back to class. And we'll be discussing about international corporate finance, corporate finance. And in this module, we will look into foreign exchange, the definition of foreign exchange. We'll also look into foreign exchange risk management, financing of multinational businesses, and we also look briefly at cross-border merger and acquisition. When we talk about international corporate finance, business operates in a global economy facing unique financial challenges and opportunities that differ from domestic settings. And international corporate finance focuses on the principles and strategies needed to be able to manage such a firm's operation globally. And it involves managing foreign exchange risk, financing multinational businesses, and handling cross-border management and acquisition. And the goal is to equip students with the tools to make informed financial decisions in the interconnected world. And having an understanding of foreign exchange, it's actually an abbreviation of FX or Forex, like if to be abbreviated, it's FX or Forex, and it refers to the process of converting one currency into another currency for purposes such as trade, investment, tourism, and international finance. And it represents the global marketplace where currencies are bought and sold, and their values are determined by supply and demand dynamics. And in business or finance, foreign exchange is the system through which international transactions are settled by exchanging the currency of one country to that of another. And looking at foreign exchange rate, it's actually the price of one currency in terms of another. For example, I think when we talk about exchanging dollar and naira now, a dollar is worth about 1,500 plus or minus 1,500, and in the black market, and that's the foreign exchange rate. And foreign exchange market, it's a global decentralized marketplace for currency trading, and it is the largest and most liquid financial market in the world. Looking at the risk aspect of foreign exchange risk, sometimes called currency risk, often occur when changes in exchange rate impact the value of a firm's asset, liability, revenue, or expenses denominated in foreign currency. And we have this in three types. That means the foreign exchange risk can be recognized under three types. We have the transactional risk, we have the translation risk, and we have the economic risk. And for the transaction risk, this arises from contractual obligations in foreign currency, such as export, receipt, or import payments. And for example, if a Nigerian exporter invoices in US dollar, but the naira appreciates before payment, the exporter receives less in domestic currency terms. And for translation risk, this result from consolidating financial statements of multinational companies. Exchange rate movement can alter the reported value of foreign subsidiaries' assets and earnings. And lastly, on the type of FX risk is the economic risk, and it refers to the long-term impact of exchange rate changes on a firm's market value and competitiveness. And for example, a stronger home currency may reduce the international competitiveness of exports. How do we then manage foreign exchange rate? We'll be focusing on hedging. What is hedging? Hedging refers to the deliberate use of financial or operational strategy to be able to offset potential losses from exchange rate fluctuation. And the goal is not to maximize profits, but to reduce uncertainty and stabilize cash flow. And common hedging techniques that are being used include the forward contract, and this is an agreement to buy or sell a specific amount of foreign currency at a predetermined rate on a future date, and they provide certainty but lock the firm into a fixed rate. We also have another technique called the future contract. And this is a standardized contract traded on exchanges to buy or sell currency at a set price in future. And future offers liquidity and market transparency, but requires margin deposits. And we also have the option contract, and this gives the firms the right but not the obligation to buy, that is call option, or sell, which or put option, foreign currency at a specific rate before expiration. We also have the money market hedge, and this is the use of borrowing and lending in domestic and foreign markets, money markets, to create synthetic forward position, thereby reducing exposure. And we also have the natural hedge, which is also called the operational hedge, and it involves structuring operations to match revenue and expenses in the same currency, such as sourcing input in the same currency as export sales. What are the international financing strategies available as per multinational corporations? So multinational corporations must decide how to finance their global operation, balancing diverse capital sources across different countries. And we have sources which include the internal and the external financing. When we talk about the external financing, it includes the equity financing, debt financing, and hybrid instrument of financing. And I think we've talked about it in a past module where we talk about equity financing as the use of shares, maybe selling of shares to be able to use it to fund the company. But now let's take it in the aspect of multinational corporation. So multinational corporation can issue shares in home or host country stock markets, or through global offerings such as American depository receipts and global depository receipts also. And for the debt financing, it's the borrowing from local banks, issuing international bond, or obtaining syndicated loan, allowing the multinational corporations to leverage cheaper financing option available in certain markets. And for the hybrid instruments, these are instruments such as convertible bonds and preference shares, which combines features of debt and equity, offering both flexibility and access to a wider investor base. And when we talk about the internal financing, it is using of retained earnings from foreign subsidiaries or intra-group loan to be able to finance the operation of the company or the business. Now, the last aspect we'll be looking at is the cross-border merger and acquisition. When we talk about cross-border merger and acquisition, it's actually the process of acquiring or merging with a company in a different country. And what's the motivation for merger and acquisition here? First is accessing new markets. That is, such a company gains a foothold in new geographical area. Another is acquiring strategic assets, which is obtaining new technologies, brands, or skilled labor. And lastly is achieving economics of scale. And this deals with reducing cost by increasing production volume. And the challenge of this include cultural integration, regulatory compliance, and also complex valuation. These are the challenges that have been faced in terms of cross-border merger and acquisition. Other challenges as pertain to The challenges and complexity of merger and acquisition are the exchange rate fluctuation, which deals with this directly affects the value of international assets and profits. We also have the political risk. We have the taxation difference, where we talk about varying tax law across country, which can complicate financial planning, and also the cultural integration, dealing with the cultural differences, which can affect or impact management and operations in cross-border merger and acquisition. In conclusion, the international financial landscape presents both significant opportunities and complex risks, and success depends on the ability to be able to balance both global expansion with effective risk management, and a sound understanding of international corporate finance is essential for any business seeking to thrive in a globalized world.